Welcome to Beyond Now, brought to you by CapitalHQ, the operating system for private capital. Every episode, we sit down with people allocating serious money in Australia's private markets. No noise, no headlines, just signals. So today, we've assembled 4 investors who sit at different points of the capital stack to map what comes next. We have Ryan Bass, founder of Panjan Capital, opening institutional-grade Australian property to wholesale investors. And then we have Scott Kelly, CEO of Real Asset Management Group, $8 billion across credit, real estate, and private equity. And then we have Cyril Pham, CEO of Harbour Credit Partners, one of the sharpest seats in Australian private credit, and Jared Stewart, founder of Sharpridge Funds Management, our global equities voice, here to keep the property bulls honest. So before we start, one housekeeping note, everything you hear today is general information for wholesale investors. It is not personal advice, so speak to your own advisor before acting. And gentlemen, welcome to Beyond Now.
Hello.
Thanks for having us.
Thank you. So 18 months ago, the conversation was rate cuts. For today, 4.35%, inflation above 4%, and the biggest tax reform budget in a decade. So I would like to ask one sentence each, like what is the single biggest change you've made to your strategy since the beginning of this year?
I'll start there. We haven't made any changes to our strategy. We focus on institutional grade Australian core property, which I think where we are in the cycle, we're seeing very strong rental growth driven by population growth, but critically very limited supply due to surging construction costs, which are up probably 35% over the last 5 years. And as we're seeing strong rental growth. So no change to our strategy.
And similarly with us, if we focus on commercial real estate, as Ryan does, plus credit, within the credit world, we've always been focused on lower risk end of the private credit spectrum. Really, we've got an on-bank lender called Brighton Home Loans. We originate almost $500 million of mortgages, and that really forms the basis of our credit offering. So really what we've seen rather than adjusted is more focus on what type of risks that people are facing and their post-tax returns after inflation. And I guess that story is very relevant for this discussion and one we're having with clients.
And from a global equities perspective, we're really focused on finding those quality growth companies, as we always do. However, in terms of changes to the portfolio with the US-Iran war sell-off, we took full advantage of that and really rotated into some tech and AI names in particular to benefit from the rebound and recovery that we've seen in the likes of the NASDAQ and global equity markets.
Yeah, I think similar sentiment to all the other 3 gentlemen in terms of core strategy. I guess we haven't shifted our core strategy, which tends to focus on investing in short-term real estate bridge loans against completed properties only with no construction, no development risk at relatively modest gearing levels. And I think in some ways, the relatively unexpected increase in rates has kind of reinforced at least that strategy. What it has made us more mindful of is the gearing that we're entertaining going forward, particularly in where residential property markets are obviously have softened considerably post both interest rate changes, the uncertainty around US-Iran, and also recent changes to the budget in terms of the manner in which these types of properties potentially taxed from an investment standpoint going forward. Having said that, it also presents opportunity. Obviously, with rates rising, it means that borrowers are less likely to satisfy bank servicing ratios, which obviously increases the demand for asset-backed lending or asset-backed loans. So I guess the opportunity set for us has, I think, potentially improved as a consequence of that. So.
Mm-hmm. I'm going to ask this question in the middle. I'm just going to drop it in the middle. So term deposits are paying near 5%, so risk-free. Make the case to family or office who's watching this for taking any illiquidity or equity risk right now. Are investors actually being paid enough for it?
Well, do you go?
I'll go on. I'll lead off. I think I know what you're going to say, Ryan. So look, if you think about our offering to that space, you've got to really take into account inflation. So what's your real return from term deposits? Then you've got a reinvestment risk. So the headline rate might be attractive, but ultimately what's going to be your likely outcome going forward. And then you can compare that to the asset classes that we invest in, being real estate and credit. So our core real income fund, for example, does cash plus 4. So it's paying 8.35 at the moment. So you would anticipate that's going to give you a lot of buffer in terms of inflation protection going forward, certainly more than a term deposit, and it's monthly liquidity. So you're actually not having to lock your money up as long as a term deposit. I think similarly with real estate, I'm sure Ryan would agree that actually now is a great entry point because you're on a risk-adjusted basis, you're buying things below replacement costs in commercial real estate land, typically in almost every sector. And where you can do that, that's turned out historically to always be a good thing if you want to make money from commercial real estate, and certainly more than you can get out of a term deposit. So that is obviously less liquid, but the environment now is definitely ripe for that type of investment.
And I completely agree with Scott on that. I mean, real estate does have inflation protection sort of benefits as well, but Scott's bang on in the sense that generally the asset class we invest in provides total returns over the medium to long term of 8 to 10%. Given that the markets have real estate is now significantly repriced over the last few years, so you've got a higher incoming yield, but you've got that really strong rental growth on the back of that, that issue with replacement cost and surging construction costs. So as a result, we're actually targeting double-digit returns in an asset class that, as I said, typically provides a much sort of steadier, slightly lower return. So we believe that it is a very attractive asset class, and we focus on the total return for investors. That's income plus capital growth.
And I'll jump in the middle of the property. So from a global equities standpoint, I feel that we're in the middle of a cycle. We're not at COVID or GFC lows, but we're also not particularly expensive either, given the strong earnings and the growth that's coming through, particularly in corporate America. So what we're positioning for is continuation of that, and as a long-only fund, our investors get the benefit of that, as well as our stock selection. So to date, since we started, returned 96%. So that's obviously, a lot of that components come from our stock selection, and at the moment, things like our average PE ratio and the earnings growth are all looking, from a portfolio perspective, very, very strong compared to the market. So really targeting to outperform the MSCI world and to generate higher returns. So hopefully there's an equity uplift from markets, plus also something from ourselves as well, whilst also keeping in mind that markets can be going through a tough period throughout the middle of the year. We really focus on the long-term prospects of companies and what those businesses are doing in the medium to long term when we buy, and we suggest our investors do the same as well with their investments.
I guess the debate between listed and unlisted and liquid versus illiquid. Look, obviously, if there is a liquid opportunity providing a similar or better risk-adjusted return than a unlisted or illiquid investment, clearly, it makes sense to gravitate towards the liquid investment option. But the reality is that's often not the case. The reason why there is a premium above listed or more liquid investments in illiquid investments is due to the equal liquidity premium, right? So there's actually quite a logical and rational reason for the existence of that. Hopefully, in addition, the premium is also due to scarcity of capital in that specific segment, maybe due to complexity or potentially perceived default risk in that segment, which then warrants, I guess, the skill of the manager to harvest that premium. But look, and I think Scott makes a very good point. The 5% headline return looks good nominally, but from a real rate return after accounting for inflation, right? It's not all that great in the end. Having said that, I think the reality is most investors often focus on the nominal rate of return, So it does make them more acutely aware and potentially selective in terms of their allocation decision. But at the same time, you ultimately have to generate a real rate of return. And often, the illiquid investment alternatives are a viable manner in which to do so, provided you can tolerate the illiquidity associated with it.
I would like to ask this question from Ryan Bass. PAREF, Panjan Australian Real Estate Fund, opens the door to institutional core funds. The premium shopping centers, logistics, and office towers previously reserved for super funds and sovereign wealth. Why are those institutions making room for wholesale money now?
That's a really good question. So firstly, this sector that we're investing in has been operating for decades. In fact, even since the 70s, institutions were investing in property. The current institutional sector generally is not able to be invested in by non-institutional investors. To get into these big institutional funds that we're in, you typically need a check size of 10 or 15 million, and you have to be structured correctly to get into these funds because they're very efficient. There's basically no stamp duty to get in there. Now, I think many institutions, like the big managers, have actually thought about trying to tap into the non-institutional, market for these funds, but they're just not sort of really suitable for these smaller investors. So what we've done is we've essentially, and the managers have been very supportive of our strategy because they see us as a channel for allowing smaller investors to come into these assets. So and so we're essentially pooling wholesale money together to invest in these incredibly high grade portfolios that objectively speaking own, I would say, the top, the best real estate in the country, better than REITs and better than non-institutional property strategies. So they have been incredibly supportive. They've wanted to tap this market before, but they haven't really been able to in a meaningful way. So I think that's why we're provide that opportunity for those investors.
I think, Bella, if I could just add something in there, that if you look at what's happening in commercial real estate, it's not that the institutions are no longer there. They're there and they're in massive size. So if you look at things like Centuria's result, the listed folks, if you look at Centuria's or Charter Hall's results, I think Charter Hall had the biggest inflows into commercial real estate they had for 20 years, something like that. So what that tells you is this, the so-called smart money, the institutional money is definitely allocating and increasing allocations to commercial real estate. They could be domestic, often they're overseas. So we kind of approach it from, we arrive at the same point as Ryan, but we'd probably get there in a slightly different way, in that I guess our business has been focused on institutional grade investment opportunities, but we provide wholesale investors the opportunity to sit alongside those in the same assets, the same underlying investments, but they have the same exposures. So ours is trying to blend two different sources of capital within the same investments.
Scott, you've also called Brisbane office a once in a cycle, once in a lifetime opportunity. Supply constraints, interstate migration, the 2032 Olympics. What do you see in Brisbane different this time, and what do you think the biggest opportunity here is, and how much of the Olympics is already in the price?
Yeah, so I think you could almost answer that without mentioning the O word. So supply and demand. So Brisbane is structurally a physically constrained. You've got the river around one side, and you've got hills around the other side. You've got construction costs being high and elevated for a long time in Brisbane. So the replacement costs, you can buy things way below replacement costs. They're just not going to build out there. So that will constrain supply. You've got on the demand side, you've got the fastest growing population in the country. People are moving not over from overseas, but interstate to move into Southeast Queensland. That typically drives everything with real estate, but that's causing more and more demand. So if you look at the forecasts, you could look at anybody's forecast for rental growth. Brisbane the last time we looked at it, was the fastest forecast. So it's forecasted to grow faster than any other city in Asia, though not just Australia. So that seems slightly counterintuitive for Brisbane, but then you add on all the infrastructure spend, so the Crossrail, the freeways. In addition to that, it's really I've been in Australia for 16 years and I can never remember such a disparate picture between the states. If you take Victoria versus Queensland, for example, you've got everything is pushing on in Queensland, and that creates this great environment, particularly when supply is constrained. So to Ryan's point earlier, you can now basically, so for example, you can get a 14, 15, 16% return for fully completed, fully leased out. You don't have to do anything. You don't have to develop anything. You just have to buy it and sit there and collect the rent and increase the rent every time somebody moves out, and you'll get a 16% return. And that for us is a really good risk-adjusted trade.
Mm-hmm. I think the elephant in the room would be Victoria. So some investors are now calling the state uninvestable. So are you avoiding Victorian property, or is that exact sentiment where the mispriced value actually sits?
Well, I think you can invest in Victoria. You might want to do it in a different way. So again, the biggest variable being construction costs. So if you want to develop anywhere in the country, Victoria might be one area you could look at, because the construction costs have leveled off. They're still rising everywhere else in the country, particularly in Queensland. So that means that feasibilities will more likely stack up in Victoria. So I think in selective areas, you could say that if you take a long-term view, it's a good buying opportunity, and certainly development, if you're going to develop anywhere in Australia, probably Victoria, given that sort of expectation of construction costs being relatively flat, certainly compared to everywhere else. That's certainly the way that we look to play it in Victoria.
Mm-hmm. Cyril, I think you lend against built residential property on the eastern seaboard, right? So
that's correct.
Forget about the headlines, but what does your loan book actually tell you about where Australian property is generally stressed and where it's stronger than people think?
Well, actually, touching on Victoria, ultimately residential property is a consumptive asset, right? Driven primarily by owner-occupied buyers and demand. And ironically, Victoria presents probably one more affordable markets actually for people to buy. I mean, yes, there's obviously all the doom and gloom in there, and certainly property values have not probably grown to the same degree that other metropolitan cities have. But I guess in some ways, the affordability of the product actually means that arguably it provides potentially a more stable market at this point in time relative to, say, Sydney, for instance, where I think it's well documented, I think now, that right now things are pretty slow. Clearance rates have been at its lowest for 6 years, particularly in less affordable suburbs, as we've seen. We've observed considerable drawdowns in some of the more premium areas of Sydney, which is just a timely reminder of the fact that those premiums represent a more illiquid product as well, and also are constrained by affordability, right? So actually, we're actually quite cautious at the moment in terms of how we lend in New South Wales, particularly with revaluations being based on historical data, but may not necessarily reflect forward-looking conditions, right? So sales from, say, December of last year may not, in fact, be all that relevant anymore, right? So there needs to be a greater preponderance of recent sales data for us to be a little bit more confident in terms of the gearing that we may otherwise extend in, the more glamorous parts of Australia, including Sydney. Whereas Brisbane, Victoria, Adelaide, actually, arguably present more stable auction markets and clearance rates. And so you can take a little bit more of a relaxed view, I guess, potentially on the gearing that you provide there. But I think it's totally right. Not all markets are the same, right? Even pockets within Sydney and Victoria also have, significant dispersions, right? So something as supposedly as simple as a residential property is not a monogamous asset class, right? It's dependent on jurisdiction. It's depending on property type. And as Scott, rightly mentioned, depends on supply and demand dynamics within those specific suburbs and locations.
Just to end this segment, I would like to give you 30 seconds each. With population growth and undersupply on one side and high rates and tax reform on the other side, are we looking at a buying window here or a market that's permanently changed?
Well, I might lead off. So I mean, we've been doing a bit of thinking about this, because if you think about high net worth, the people that might be tuning in, they'll be within the 2 million households in Australia that own more than one property. So there's going to be a lot of exposure. And the last time I looked at it, 40% of high net worth allocation was in physical real estate of one side or another. So this is a real issue that will definitely cause shifts in capital. And you add into that elevated rates, elevated inflation. So we, in our modelling, and to Cyril's point, very difficult to pick a suburb. But let's say they've got a penchant for units in South Yarra. They're probably looking at a post-tax negative return, or if they leverage it. If they don't leverage it, then they're looking at certainly sub 2% total returns over the next few years. Compare that to commercial real estate, you're getting 6 upwards for no, that's core commercial real estate. Plus, you don't have to do anything, and you don't have to find a financial planner and a buyer's agent and deal with the seller's agent and so on. You just have to put your money in the fund and check your account every quarter. So I think if you think about those type of returns, there's also the emotional component. You might want to buy an apartment for your kids in South Yarra, and why not? But if you're looking from a pure investment perspective, it's less attractive than it's ever been, and certainly relative to commercial real estate. The types of leases, the types of tenants, the types of returns you're going to get post-tax, post-inflation, post all costs, is significantly higher in commercial real estate now than in residential.
I would definitely concur with Scott. And I think another thing to add to the mix is the negative gearing changes. Whilst that's probably a net negative for residential, but although there's a benefit for new builds, if you're an investor going into a new build, well, your next buyer is not going to have that benefit of the negative sort of gearing. So I think there's a lot of reasons why commercial property is now even more attractive than it was before, with all the reasons that's sort of Scott mentioned. You've got a higher incoming yield, you've got population growth, you've got low supply outlook and strong rental growth. So I do feel that commercial property is very attractive at this point in the cycle.
Fantastic. Thanks, Ryan. Look, I'm based in Brisbane, so I tend to agree with Scott that the Southeast Queensland property market, you mentioned before, has a very good outlook with the Olympics coming through in a few years' time. I guess a few insights from my perspective, being a little bit of different aspect from global equities. One of the things we like to do is buy the dips in a market. Usually when there's a correction, it's usually a good time to buy. So I think the changes that are happening, particularly from the budget and things which are not good in terms of the property market, may create a buying opportunity if we see any sort of change back in the opposite direction, which seems to be sort of somewhat of a consensus amongst the general voting population. So potentially, the government or a change in government may happen, or there may be changes that happen, and then all of a sudden we're going back the other way. So I think if you get your timing right, this could be a really good buying opportunity. The other thing we're seeing from the budget and changes that came through there is obviously it's negative for Australian investors investing in Australian-based assets. But what we're also seeing is a bit of a shift across to global equities as well, where at least the companies themselves aren't impacted in terms of their tax that they're paying. If they're based in Europe or the US, it doesn't really make any difference to their earnings. Obviously, it does make an impact to Australian investors. So we're seeing like a switch out of, say, Australian equities across to global equities. And I think that's happening institutionally as well as on a retail level as well. So that'd be the key insights I'd draw out from a global manager perspective.
Yeah, look, I think Jared's right. I mean, if to be honest, if you're an owner occupier looking for a new home, it's probably one of the better times in recent memory to potentially be a bidder. Obviously, the stock supplies are quite large. The competition is negligible, I guess, for that stock as well, given all the relative uncertainty. So if you do have a high degree of cash equity available to support yourself in those purchases, it probably does warrant exploration. I think I shared Ryan and Scott's view. Like, I think that the merits, unfortunately, of residential property investment are substantially diminished with the potential budgetary changes. I mean, typically, the residential property investor was very happy to accept a very low cash or rental yield on the expectation that there would be supernormal capital growth in the long term. But for the variety of reasons that Scott and Ryan mentioned, I suspect that supernormal capital growth will potentially be compromised, and also taxed at a considerably higher net rate, right? So in some ways, property investment starts going back to, I guess, what resembles in other developed property markets, where you kind of look at the ongoing rental and cash yield, right, and a much greater acute focus on the ongoing investment yield, as opposed to what the potential capital growth of the investment will be. Ironically, obviously, the focus on owner-occupier properties means that's really, I guess, as an equity investor, your own owner-occupier home still being free of CGT, arguably probably represents still the only best way to have an equity investment in residential property. But again, the focus on ongoing yield means that maybe you look at fixed income securities or mortgages against owner-occupier property, right? And the yields that are there, which represent probably a far superior outcome than the rental yields that you might otherwise achieve on residential investment property.
The one thing I'd add to that with property is that you've got your to what Cyril mentioned, is you've got your income yield of, let's call it 5-6%, or depending on the quality of your asset. But that rental growth, where let's say in the past few years has been, or let's call it 2.5 to 3.5 or whatever it is, it's probably now ramping up to 4 to 5 in some of the better quality assets. And every year your capital growth, presuming there's no change to cap rates or things like that, where we're actually seeing potential tightening in the better quality assets, you're getting that rental growth is basically baking in the future capital growth as well.
Cyril, you screen lenders for a living, so risk premiums are compressing and lenders are being paid less to take risk. What separates managers who survive a default cycle from those who won't?
Well, look, I guess everything, with the benefit of hindsight, is a good thing. And obviously I can only speak to, I guess, how we've approached things historically. Thankfully, in the areas that we've been investing, there still seems to be quite a healthy spread and margin available to us, notwithstanding not having to take construction development risk. And that's partly just due to that being more scarcity of capital in the sector we operate in. The reality is construction development finance, I guess when I first observed it in the non-bank lending sector back in 2016, the risk premiums were quite healthy, just due to the beginning and emergence of that sector. But obviously it has matured considerably over the past 10 years. And logically, with the entry of such a large wave of capital in the sector, has just led to more competition and supply of capital for projects. And the reality is the development environment has been very challenging the past few years. So the availability of feasible projects has also diminished, with the operating costs of these projects having increased substantially, with the re-emergence of inflation, right? And now, obviously, with real rates increasing as well, right, it potentially leads to a softening of completion values. So, projects which may have been marginally feasible last year have just become suddenly, more marginally feasible, if at all, right? So, and you combine that with a large supply of capital looking to deploy into those types of projects, naturally you see, I guess managers with, a lot of cash available to them, not doing very much, and it is human nature ultimately to want to deploy, right? So as a consequence, acceptance of lower, lighter covenants, higher gearing ratios, less pre-sales requirements, and extending higher degrees of leverage without requiring significant sponsor equity has been a natural consequence of that. So again, thankfully, we've managed to, I guess, consciously stay away from those types of investments, again, sticking to, I guess, relatively, straightforward, although nothing's really straightforward in what we do, but, I guess lending against collateral, which is completed, primarily residential only, such that, in terms of disposition of that collateral is relatively straightforward as opposed to entering into a half-built construction site, right? And that's put us in good stead. But look, having said that, if I was a construction development financier, I may have made the same errors, right? Again, we're all human.
Scott, you see private credit from every angle at real estate management. Two things are happening at once. So banks want their lending back and everyone is piling into private credit. Both squeeze returns. Are we past the peak?
No, I don't think so. So if you think about what's driving that, to your point, it's with banks withdrawing from certain lending activities that they have done historically, and then secondly, this aging population yearn for yield that's chasing any kind of income. That's led to floods of capital going into credit funds generally, but the same amount of deals exist. So what the risk is that the asset managers will chase those yields either by maintaining the yields and taking more risk, or you're going to have return compression in that market. So I think we sit sort of on both sides of that fence. We do allocate some external capital, but most of it we originate ourselves, and that's a really important differentiator for us because we have our own mortgage business. People use the phrase non-bank lender as a variety of things that they would be describing there, but ours is regular mortgages. There's $5.5 billion in the book. The average mortgage size is 600 grand. There's 10,000 odd mortgages in there. Average LVRs 66%. So these are regular, regulated, secured mortgages across residential property in every part of Australia, but with a focus on Metro Australia. So that's different because we don't have to go and chase the deals with everybody else. We originate our own, we create our own deal flow through that business. And that, if you think about, so that takes the pressure off us, I think, as Cyril said, to deploy into external credit deals because we can create our own. So we become a price maker. We set the prices of the mortgages rather than a price taker where we're chasing deals into the market. So I think having a view on both sides of the fence, but really having your own origination platform, which is what Brighton Home Loans is, that creates a significant point of difference, which means we won't be chasing these yields down as you have more and more capital chasing the same level of deals as the population grows and ages, and yield becomes even more important in a higher inflation environment.
Jared, you're the only one here not in private credit, so you can be the skeptic. The warnings are stacking up globally. Funds marking their own homework, borrowing on top of borrowing, and promising people their money back fast when it's locked up in loans. As you were mentioning before, corrections. Is this a bubble waiting to pop or a maturing market that critics misunderstand?
Look, I'd probably go with the latter, more optimistically, that private credit fills a really important role in people's portfolios, both institutionally, wholesale, and on a mum and dad level. So I feel like it's very important, and returns in that sector generally, like a lot of private assets, quite persistent, and we're going through some issues with not every manager, but some managers where there's illiquidity issue. But I feel like the sector as a whole has a lot of good managers, and the investors really need to do their due diligence on what is in the fund and what is the strategy of the fund that they're investing in, and not taint everyone with the same brush. I think there's a few players that have issues, but there's a lot of great private credit managers out there, and it's a really important space that the banks have pulled away from, and is becoming more and more important, particularly as the population ages and the economy gets more and more dynamics. So I feel like it's grown for very good reason over the last 5 to 10 years, and has great prospects ahead. But just people need to do their due diligence when they're investing in any fund.
Thanks, Jared. So this is the segment our audience actually came for, I think. 2 days is very important. 1st of July 2026, the new tax on super above $3 million. 1st of July 2027, negative gearing limited to new builds. The 50% capital gains tax discount replaced with indexation, and a 30% minimum rate and the 30% minimum tax on discretionary trusts the year after. Let's get very practical here. So this tax has wealthy families on the move, pulling money out of super and parking it elsewhere, like all year. You're talking to these people every single week, and what are they actually doing with it? And is any of it actually flowing into what you are offering?
I might kick off then. And just to clarify, Bella, we're not in private credit. We're an equity real estate investment fund. But yeah, I think with all these changes, and as I sort of mentioned before, I think it is generally positive for commercial property. However, my discussions with a lot of the financial advisors have reinforce that they believe, residential, there might be some more sort of headwinds, and commercial, there's more tailwinds. But what we've found from a practical impact over the last few months is a lot of financial advisors and accountants and investors are, I guess, taking it a bit slower to try and understand how they need to be structured sort of going forward. So I think there's for some investors, it's a bit of a pause, but I think it's going to be structurally a very positive outcome, at least for our sector and asset class, because, the returns, our returns at the moment, we're offering sort of double-digit returns, roughly a bit under half of that is income returns, the rest is capital returns, and there's a tax advantage component to that. So I think there's some real benefits in our sort of investment structure for these changes. But I'm no tax expert, so I don't. People need to get their own advice.
Yeah, I guess I would sort of echo some of those sentiments. I think people are sitting on their hands generally to see what the carve-outs are and what might be included and excluded. It seems to be there's going to be a bit of chipping away when. Well, you would have thought that when Labor realises how deeply unpopular these changes are, when everybody works out their impact across the economy. So, but also I think what you're going to have on residential real estate is a lot of, you're going to dry up liquidity in the investment market, because everyone is just going to retain the way, if it works out the way it is today, everyone's going to keep the one they've got, the grandfathered one, and they won't be buying the next one and buying the next one. So that's going to dry up that market probably. Obviously, it's not good news for Jared and his equity funds, equity investors. It is better news for commercial real estate. I think there will gradually be more focus on what are the tax effective structures. So they could be VC type funds. The fund itself could be more tax effective. That will naturally become relatively more attractive? There might be other structures like that. And then how could we house people's investments effectively? So, for example, we're doing a bit of work on insurance bonds at the moment. Again, to Ryan's point, we're asset managers, not tax advisors, but life insurance policies, that kind of thing. You know, you could call them education bonds, those kind of products. They might form more of a significant part of people's wealth planning structuring outside of family trusts and superannuation. So you might end up in a third bucket where people put their long-term savings in that typically get all the advantages if they leave it in there for 10 years. So you might see some evolution of new vehicles one way or another.
Jared, I think the capital gains tax not only affects property, but it actually affects the shares and whatever you own for growth. So does this change what you'd buy, how you'd hold, and when to choose to sell?
Sure. Well, look, from our fund point of view, we're a unit trust, wholesale unit trust. So it doesn't affect us. The changes from the budget affect our investors and the tax that they may pay as Australians. So in terms of when we deploy money in the trust, probably makes a change in terms of, do we buy a domestic company or do we buy an overseas company? So we've reduced our weighting to Australia slightly. It sits now at 2%. It was probably around 3 to 4% when the changes came through. So it's very limited impact in terms of our portfolio. Most of our investments, being a global manager, are in line with the benchmark, the MSCI. So it really doesn't have a lot of impact on those companies that are invested in, which makes up 98% of our portfolio, being offshore. So not a lot of changes from our point of view. We are seeing some investors do some reallocation from Australian equity funds to global, to us, as well as other global managers, where they're seeing that the companies that we invest in aren't affected, being offshore, and so they're doing a reallocation there. So that's probably the biggest change we're seeing. But yeah, we're a unit trust, so it all just flows through in terms of our returns on a pre-tax basis.
Okay, so I'm leaving the stage to you. Is there anything that you would like to share about the interesting things happening in the company or the updates that I haven't asked yet and you wanted to share?
I'm happy to go first. I haven't done that yet. So thanks, Bella. Probably the main thing we'd see in terms of corporate US earnings, they're actually being revised upward. Usually at this time of year, earnings are being revised downwards. So the US economy is just firing on all four cylinders at the moment, which is counter to normal at this time of year. So I guess even though the valuation multiples are quite high, to a large extent, they are justified that earnings are actually improving. And that's what the key is for us when we're analysing businesses. So we're quite positive in terms of equity markets globally, and see a lot of opportunities for us to do stock picking, particularly in the US at the moment, but generally across the globe as well. We're really a concentrated manager, so we're looking for those 20 to 30 best ideas in our portfolio, and we've identified a few really good opportunities lately that we'll be coming and investing in the next few months. So we're quite positive in terms of future portfolio positioning and the outlook for our fund going forward.
I think I'll go next. I think what we're seeing is really our focus on the best quality real estate in the country, in lowly leveraged structures with limited development, is really where you want to be in this environment. We do think that there are sort of elevated risks in other forms of property, and particularly with that rental growth that we're seeing sort of coming through, is a really strong driver. And I think Scott might have said sort of earlier, we are seeing a lot of institutional capital coming back into the sector. One of the funds that we're in they were targeting a raise of 500 mil. They raised oversubscribed at about 600 over 610 mil. There was another fund that we were in where 600 mil of new equity came in. There was a $500 million check from one large institutional investor. And we've seen just constantly transactions where I wouldn't say the smart money, but the big institutional capital are seeing a very attractive environment for Australian core real estate, and we expect to see continued capital flows there, which may even result in some cap rate tightening, or which is I guess in equities terms, it's kind of PE expansion. So we do feel it's a very attractive time in the market.
Yeah, I mean, from my side, just to follow up Ryan's point, I think there's two words. If you think real estate, the word that strikes me is value. There's definitely value in commercial real estate right now. You can buy all the things that Ryan just said, both in the listed and the unlisted world. You know, we're talking about the REIT market at the moment. You're getting a high single-digit yield. You could put that and lock that away for a few years, and hopefully that the overcorrection that you've seen in that market may partially unwind, and you've got a double-digit return for some very simple investments. I think the other thing I would say is what that value is meaning you're getting returns that are one notch away from where they used to be. So if you think about different types of risk profile of commercial real estate, you've got core plus, value add, opportunistic development. You're basically getting, for example, you know, value add type of returns for a core investment right now. So that's another way to think about it, is you're getting rewarded for the risk that you're taking. And that's probably the best way to describe real estate. In terms of credit, the word I would use is selective. So I think you've had a lot of money chasing those credit deals. What we offer is, we specialize in boring. Ours are secured Aussie residential mortgages, highly diversified. We own the first loss piece, which is important considering it's we're 100% staff owned, so it's really our money on the line. We've never lost $1 in 8 years, and we have arrears lower than the big four banks. So that kind of credit to us is attractive, particularly relative to a property development, overseas lending, or corporate lending.
Yeah, I share Scott's sentiment. In some ways, I guess somewhat of the turbulence experience now, it's a reminder that credit sometimes shouldn't actually be all that exciting, actually. You know, I mean, I think unfortunately, fundamentally, the word private credit has been somewhat glorified in some ways to make it seem very new and sexy, and unfortunately has led to the chasing of, I guess, high yields. But, you know, high yields obviously necessitate higher degrees of risk, and I think that's started to really translate. And investors in the private credit space have now really started to acutely feel that, right? So I guess, you know, similar to Scott, we focus really just on lending against completed, you know, primarily residential properties, though we do have some commercial, industrial, retail property exposure, though they have to be occupied and the ability to be tenanted and used. Ironically, actually, the exit strategies for some of those positions we have is the sale of those properties, and actually demand for those bids have been quite robust, actually, which is probably an early indicator of investor sentiment moving and shifting away from residential property investment towards you know, commercial, industrial, and retail property exposure, just based on demands at the auctions we've been observing from the sale of those collateral properties. Look, I think obviously going forward, you know, we still see a great opportunity in what we do. You know, we're generating essentially a 9.25% net yield, you know, sub 55% gearing against completed properties only. And right now, you know, whilst a lot of businesses are experiencing pressure, they will still borrow to relieve that pressure, whether it's due to ATO pressures, unsecured creditor pressures, you know, and so, but are still requiring relatively modest levels of leverage against those properties to address those issues. So I think for the moment, I think we're quite optimistic, and obviously the fact that servicing ratios are going to be more challenging. So the ability for these sponsors and borrowers to go to the banks means that they're more likely to go to, I guess, lenders such as Scott and ourselves, essentially. So.
Mm-hmm. Thank you very much. So that's Beyond Now for this episode. 4 takeaways worth holding on to. Many thanks to, again, Ryan Bass of Panjan Capital, Scott Kelly of Real Asset Management Group, Cyril Pham of Harbour Credit Partners, and Jared Stewart from Sharpridge Funds Management. Beyond Now is brought to you by CapitalHQ, where private capital connects on signal, not noise. If this conversation sharpened your thinking, subscribe to the channel. The next episode goes further. Until then, invest beyond now.
Thank you.
Thank you very much.
Thank you. Thank you.
Thanks, Bella.
Thanks.
Thank you. Thank you very much.